Imagine waking up tomorrow and finding out that the most powerful financial institution in the world has quietly decided to change the rules of the game. The same rules that affect your mortgage rate, your credit card balance, your student loans, your investments, and even the price of groceries. That's not a conspiracy theory. That's exactly what the Federal Reserve just did. For decades, the Fed has repeated the same mantra: keep inflation at 2%, keep unemployment low, keep the financial system stable. But just hours ago, the Fed's chair signaled something different. They admitted that inflation may never return to the 2% we've been told to expect. Instead of doubling down on raising rates, they're preparing to cut them sooner than anyone thought. What does that mean for you? It could mean your mortgage gets cheaper. It could mean your investments suddenly rise in value. It could also mean your savings lose purchasing power faster than you're prepared for. This isn't just another boring update from Washington. This is about the rules that shape the economy you live in. It's about how much your paycheck is worth. It's about whether housing gets more affordable or even further out of reach. And it's about whether the next few years will feel like relief or another financial trap. The Passive Path is all about helping you navigate these shifts with clarity and strategy. So let's start by breaking down exactly why the Federal Reserve's decisions hold so much weight over your financial life. Because once you see how this works, you'll understand why a single announcement can ripple through every corner of your wallet. Are you ready to see how the Fed controls your financial reality? The Federal Reserve is not just another government agency, it's the central bank of the United States. Its decisions ripple across the entire economy. When the Fed raises interest rates, borrowing money becomes more expensive. That affects mortgages, car loans, student loans, and credit cards. If you've ever noticed your monthly payment going up, that's often the Fed's decision at work. When the Fed cuts rates, borrowing becomes cheaper, businesses can expand more easily, consumers spend more freely. The stock market often rallies because investors expect growth and higher profits, but the Fed doesn't just think about the stock market. Their official mission has three main goals. First, maximum employment. Second, stable prices. Third, moderate long-term interest rates. Think about the 1980s. Inflation in the United States hit nearly 14%. That meant grocery prices were doubling in just a few years. The Fed stepped in by raising interest rates to painful levels, over 15%. People who had mortgages suddenly faced payments they couldn't afford. Recessions followed, but inflation was brought under control. Now fast forward to 2008. The housing market collapsed. Millions lost jobs. The Fed responded by slashing rates close to zero. That move stabilized the financial system and made borrowing cheap again. It also pushed investors into stocks and real estate, helping prices recover. This shows you how directly the Fed influences everyday life. When you see news about interest rate changes, you're not just watching financial jargon, you're watching a decision that could decide whether your rent rises, whether your investments grow, or whether businesses around you can afford to keep employees. The Federal Reserve is like the invisible hand steering the financial winds. When they shift direction, everything else shifts with them. But what caused them to suddenly change their outlook this time? Why did they hint at cutting rates much earlier than anyone expected? The answer lies in a surprising twist in the jobs market. The jobs market has always been one of the most important signals for the economy. When companies are hiring, people feel secure, they spend money, and the economy grows. When jobs slow down, it's often the first warning sign that something is breaking beneath the surface. Recently, we saw one of the biggest surprises in the jobs report in years. Analysts expected over 300,000 new jobs to be added, but the reality was just 73,000. That's not a small miss, that's a massive gap. Why does this happen? Job numbers are usually first reported as estimates. The government surveys businesses, collects partial data, and then adjusts later when more information comes in. Revisions are normal, but this time the correction was huge. It revealed that the labor market might not be as strong as we thought. Another problem is that response rates to surveys have been falling. Fewer companies are reporting back. That means the data is less reliable, and big corrections like this could become more common. So what does a weaker jobs market mean for you? It could mean slower hiring. It could mean companies freeze promotions or stop giving raises. It could even lead to layoffs in industries that rely on cheap debt, like tech startups, construction, or retail. Take a real example. Imagine a family in Toronto or Chicago. The main earner works at a tech firm that just went through a round of layoffs. Suddenly, the mortgage feels heavier. The grocery bill eats up more of the paycheck. And saving for retirement feels impossible. This is the kind of ripple effect the Fed wants to avoid. Their number one job is to keep employment strong. So when job growth suddenly falls off a cliff, they start thinking about cutting rates. Lower rates can encourage businesses to borrow, expand, and hire again. But there's a catch. Because while rate cuts can boost the economy in the short term, they can also cause new problems down the road. So the real question is this: if the Fed cuts rates now to save jobs, will they accidentally create bigger risks for the future? For years, we've all heard about the magic number: 2% inflation. It gets repeated so often that people assume it's carved in stone. But here's the truth: most don't realize that 2% target was never based on deep science. It came from a simple comment made by New Zealand in the 1990s. They picked it almost randomly as a safe number with a little margin of error. The United States liked the idea and copied it. And soon, most of the world followed along. The idea behind 2% inflation is balance. Too low and people might stop spending, waiting for prices to drop. Too high and savings lose value quickly, eroding trust in the system. So 2% became the middle ground. But things have changed. For much of the last decade, inflation was actually below 2%. From 2014 to 2016, it was close to zero. The Fed tried to raise it by lowering interest rates and stimulating the economy. When they couldn't reach the goal, they came up with something called average inflation targeting. The plan was simple. If inflation stayed below 2% for a long time, the Fed would allow it to run higher than 2% later. The logic was that it would all even out in the long run. But recently, the Fed admitted that this strategy backfired. Instead of stabilizing the economy, it created uncertainty and let inflation run hotter than expected. Now they're changing their tune again. They're moving toward what they call flexible average inflation targeting. That means they'll still aim for 2%, but they're not going to panic if inflation runs higher for a while. They'll be more comfortable letting the number float above or below, depending on the situation. On the surface, this sounds reasonable. But think about what it really means. If inflation stays at 3% for years, your savings lose value faster. Every dollar you keep in a bank account buys less and less over time. Here's a simple example. Let's say you keep $100 in a savings account. With 2% inflation over 10 years, that money is worth about $82 in today's buying power. With 3% inflation, it's worth just $74. That's a big difference, especially if you're saving for retirement or living on a fixed income. On the flip side, if you own assets like stocks or real estate, a little extra inflation can actually help. Companies can raise prices. Real estate values can rise with inflation. And your debt, like a mortgage, becomes easier to pay down because the dollars you owe are worth less over time. So the Fed's shift is basically saying this: they're willing to let inflation be a bit higher than before if it means keeping the economy stable. For investors, that could mean more growth in the short term. For savers, it could mean your cash loses value faster than you realize. So the next big question is this: if the inflation target is no longer fixed, what does that mean for politics and the people trying to influence the Federal decisions? Politics and money are never fully separate. Even though the Federal Reserve is supposed to be independent, presidents have always tried to influence its decisions. Right now, there's growing pressure from the political side to push for aggressive rate cuts. The argument is simple. Lower rates make it easier for the government to borrow money. That reduces the cost of servicing the national debt. One estimate suggests that cutting rates could save the government close to $1 trillion a year in interest payments. That's a massive incentive for any president, especially for someone like Donald Trump, who has already made it clear that he wants rates cut as soon as possible. The challenge is that by law, the president can't directly order the Fed to change rates. The central bank is meant to operate without political interference, but there are ways to apply pressure. For example, the president does have the power to replace board members under certain conditions. Recently, one of the Fed governors, Lisa Cook, was mentioned as a possible target. It's alleged that she had conflicting information on loan applications years ago. Critics say this is just a political move to open the door for a new appointment. Supporters argue that any questionable financial history should be taken seriously. This is where history matters. In the 1970s, political pressure on the Fed led to disastrous outcomes. The government pushed for easy money to keep unemployment down. That decision fueled runaway inflation that eventually required painful rate hikes to fix. It took years of economic pain to get things back under control. The point here is clear. Even though the Fed says it's independent, politics always find a way in. And when political goals clash with economic stability, the average household often pays the price. So here's the real issue. Rate cuts might look good for the government's balance sheet and even for Wall Street. But will political pressure push the Fed into making decisions that hurt ordinary families in the long run? Let's break down why some people believe cutting interest rates right now could actually be a smart move. First, the jobs market is showing cracks. When the economy only adds 70,000 jobs in a month, that's a warning sign. Rate cuts could give businesses cheaper access to loans, which might encourage them to expand, hire more workers, and keep the unemployment rate from climbing. Second, the national debt is becoming a massive burden. The United States is paying hundreds of billions of dollars every year just in interest. When interest rates are high, that number climbs even faster. Cutting rates could reduce the government's annual debt payments by close to $1 trillion. That's money that could be redirected into programs, infrastructure, or even tax relief. Third, inflation has already cooled down compared to its peak. For the past year, it has mostly stayed below 3%. That's much closer to the range the Fed wants. Some argue that keeping rates high is unnecessary at this point, and a cut could help the economy avoid sliding into a deeper slowdown. To see how this plays out in real life, think about a household in Dallas with a $400,000 mortgage. If rates drop by even 1%, their monthly payment could fall by several $100s. That's money they can use for savings, paying off debt, or simply covering everyday expenses. Lower rates can also give small businesses a lifeline. A local restaurant in Vancouver, for example, might be struggling with high food costs and slower foot traffic. Cheaper loans could help them refinance debt, hire staff, and keep prices steady for customers. From an investing perspective, rate cuts often push stock prices higher. When bonds yield less, investors search for better returns in equities. That means your 401k, IRA, or brokerage account might see short-term gains. Ita Yurwo, Septis, one of the reasons Wall Street gets so excited at the mention of rate cuts. On the surface, the case for cutting rates looks pretty convincing. Jobs could stabilize. The government could save on debt payments. Investors could see bigger returns. But there are Euro Septis another side to this. What if cutting rates too early creates new problems that could be even harder to solve later? Now let's look at the other side. The reasons why cutting rates right now could be a serious mistake. First, producer prices are rising again. This is measured by something called the Producer Price Index. It tracks what businesses pay for raw materials and goods before they reach consumers. Last month, those costs jumped almost 1% in a single month. If businesses are paying more, you can bet they'll eventually pass those costs down to you. Second, inflation is showing signs of creeping back up. Even though the yearly numbers look calm, the month-to-month data tells a different story. A 0.2% rise each month may not sound like much, but add it up over a year, and it's higher than the Fed's supposed target. Third, the labor market still looks strong on the surface. Unemployment is near historic lows, around 4%. That's not a situation where the Fed usually rushes to cut rates. If they do, it might look like they're trying to juice the economy rather than stabilize it. Fourth, cheap money can fuel dangerous bubbles. We've seen this before. In the early 2000s, easy credit helped inflate the housing market. When that bubble burst in 2008, millions of families lost their homes and jobs. If rates are cut while stocks, housing, and crypto are already near record highs, prices could surge even further. That might feel great in the short term, but it sets the stage for a painful crash later. Think about someone in Los Angeles buying a house right now at a peak price. If rates drop, they might be able to afford the monthly payment, but if housing prices fall 2 years later, they could end up owing more than the home is worth. That's the risk of rate cuts during a boom. Investors face the same challenge. Yes, stocks might go up quickly with lower rates. But when the bubble bursts, those who bought at the top could see half their portfolio vanish. History has shown us this cycle more than once. So while the idea of cheaper money sounds appealing, it comes with a dangerous trade-off. The question is whether the short-term gains are worth the long-term risks. And that leads to the most important part. What does all of this actually mean for you, your investments, and your future on the passive path? When interest rates move, it creates winners and losers. If you own stocks, you're likely on the winning side in the short term. Lower rates usually push investors toward equities because bonds and savings accounts pay less. That can drive stock prices higher. If you've been consistently investing in an S&P 500 index fund, you might see your balance climb faster. If you own real estate, rate cuts can work in your favor too. Mortgage rates often drop when the Fed cuts. That means lower monthly payments if you refinance. It can also push more buyers into the market, driving home prices higher. For example, a couple in Florida with a $350,000 mortgage could save around $400 a month if rates fall by just 1%. Over a year, that's nearly $5,000 back in their pocket, but not everyone benefits. If most of your money is sitting in a savings account, higher inflation with lower rates means you're losing buying power. Your money grows slower than the prices around you. Imagine saving $5,000 for a car. only to realize in a few years that you now need 6,000 to buy the same model. For small businesses, rate cuts are a double-edged sword. Yes, cheaper loans make it easier to expand, hire, or cover costs. But if inflation picks back up, their expenses rise too. That neighborhood coffee shop in Seattle might get a better loan deal, but if milk and rent go up, they're right back where they started. And then there's crypto. Whenever central banks loosen money, digital assets often surge. Bitcoin has historically rallied when investors lose faith in traditional currency stability. If the Fed signals that inflation above 2% is acceptable, many will look at crypto as a hedge. That could mean another wave of speculative growth, but it also brings wild volatility. So where does this leave you? If you're invested, the coming months could bring strong gains. If you're holding only cash, your money might quietly lose value. And if you're over-leveraged in real estate or chasing hype-driven assets, you could be setting yourself up for painful losses. This brings us to the bigger picture. In a world where the rules of money keep shifting, how do you actually build wealth that lasts? Building wealth in an economy that keeps changing starts with controlling what you can. You cannot control interest rates. You cannot control inflation. You cannot control political decisions. But you can control how you prepare. The first step is diversification. Don't put all your money in one place. If all your wealth is in stocks, a market crash can cut your net worth in half overnight. If all your wealth is in cash, inflation can eat it away while you sleep. Spread your money across different areas. Stocks for growth, real estate for stability and passive income, cash for emergencies, side hustles for extra streams of income. The second step is consistency. No one can perfectly time the market. Even professional investors get it wrong. That's why dollar-cost averaging works. You invest a set amount regularly, whether the market is up or down. Over time, the highs and lows balance out. You avoid the stress of guessing. You focus on building steadily. The third step is risk management. Ask yourself, how much of your wealth is tied to something that could lose half its value tomorrow? If you're all in on one hot stock or one piece of real estate, you're vulnerable. The wealthy avoid this by spreading their bets. They may own businesses, stocks, rental properties, and even simple bonds or cash reserves. That way, if one area falls, another area can carry the weight. Here's an example. During the 2008 crash, many people sold everything at the bottom and locked in huge losses. But those who stayed invested, kept buying, and diversified into different assets often came out stronger. A person who invested consistently through 2008 into an S&P 500 index fund would have seen their portfolio double or even triple by the next decade. The fourth step is mindset. Wealth is not built overnight. It's built by making smart decisions over years. It's about patience, discipline, and refusing to panic when the news cycle screams chaos. On the passive path, this is the philosophy we focus on: how to build wealth calmly, consistently, and with a long-term vision. And that brings us to the final part of this journey. The lessons you can take with you today to protect your money and grow your wealth in uncertain times. Here are the key lessons you can take away right now. First, don't rely on the Federal Reserve to secure your financial future. Their job is to manage the economy, not to make sure your bank account grows. Their decisions might help you or hurt you, but they're not designed with your personal wealth in mind. That means it's your responsibility to prepare. Second, understand how rate changes affect your life directly. If you own a home, watch mortgage rates. If you carry debt, notice how credit card interest moves. If you invest, remember that stocks often rise when rates fall, but that growth can be fragile. Third, focus on building multiple streams of income. Don't depend only on one paycheck or one investment. Start a side hustle, build a small business, invest in dividend-paying stocks, or consider real estate. When one stream slows, another can keep you stable. Fourth, stay disciplined. It's tempting to chase hype when markets are booming, but quick wins often come with big risks. The people who build lasting wealth are the ones who stay calm, stay invested, and make steady progress year after year. Fifth, protect your savings from inflation. Cash loses value when inflation runs higher than your interest rate. Don't just let money sit in a savings account. Look for ways to put it into assets that can grow over time. If the Fed is signaling that higher inflation could become the new normal, you need to adjust. Think about where your money will hold value 5, 10, or 20 years from now. Think about how you can prepare for both the good times and the downturns. We're entering a period where the rules of money are shifting, and that's exactly why the passive path exists. To help you understand what's happening, and to show you how to protect and grow your wealth no matter what comes next. The economy will always change. The Fed will always pivot. Politics will always interfere. but your financial future doesn't have to depend on guesswork. It can depend on the habits, decisions, and strategies you choose today. Take control of your own path. Keep investing steadily. Build more than one stream of income. Stay patient when the market swings. And most importantly, protect yourself from the silent tax of inflation. If this gave you clarity, hit like. Subscribe to The Passive Path for more insights on building wealth and navigating money with confidence. Share this video with someone you care about who's trying to figure out what's going on with the economy. And drop a comment with your thoughts on whether rate cuts will help or hurt in the long run. Good luck on your own passive path. See you in the next video.